Macquarie Group CFO Alex Harvey steps down after 3 decades. Imagine working for nearly 30 years at a prestigious firm, only to suddenly step down from your high-ranking position. That's exactly what's happening with Alex Harvey, the Chief Financial Officer of Macquarie Group Ltd. But here's where it gets controversial. Harvey was widely seen as a potential successor to lead the Australian financial giant, which is currently under the microscope due to multiple regulatory investigations. So why is he leaving now? Let's dive in. Alex Harvey, who is 54 years old, will be vacating his role as Chief Financial Officer and exiting Macquarie's Executive Committee by the end of December. He plans to retire the following year, handing over his responsibilities to his deputy Frank Kwok. Harvey has held the CFO position for the past 8 years, playing a crucial role in the company's financial strategies and operations. The Sydney-based firm announced this news in a statement on Thursday, but notably they didn't provide a reason for Harvey's departure. This abrupt change raises several questions. Is Harvey's exit related to the ongoing regulatory probes that Macquarie is facing? Or is there another reason behind this sudden decision? And this is the part most people miss. The timing of Harvey's departure is particularly interesting, given the regulatory challenges Macquarie is currently navigating. Could this be a strategic move, or is there more to the story? Only time will tell. But for now, the financial world is left speculating about the future of Macquarie Group and the implications of Harvey's departure. What do you think? Do you believe Harvey's exit is purely coincidental, or is there a deeper connection to the regulatory issues? Share your thoughts in the comments below. Let's spark a discussion and explore the possibilities together. After all, in the world of finance, every move can have a significant impact, and this one is no exception. Stay tuned for more updates on this developing story. Macquarie Group crisis. CEO's $24 million pay amid compliance blunders. Imagine a financial giant where the CEO rakes in millions, while the company faces a storm of criticism for failing to rein in excessive executive pay. That's the reality at Macquarie Group, where outrage is brewing among shareholders over the bank's handling of executive compensation amidst a series of compliance failures. It's a tale of high stakes and high pay, where one CFO's departure is just the beginning of the drama. Alex Harvey, Macquarie Group's Chief Financial Officer, is set to leave the company after 28 years of service, a move that comes at a critical time for the investment bank. As the bank prepares for its annual general meeting in Sydney, it faces the prospect of its first ever strike, a situation where 25% or more of shareholders vote against the company's remuneration report. This move by shareholders is a direct response to the bank's failure to cut executive pay packets, despite repeated warnings from financial regulators. But here's where it gets controversial. Macquarie Group has been hit with not one, but 4 actions from the Australian Securities and Investments Commission, ASIC, in the past year, including allegations of misleading conduct by misreporting millions of short sales over a 15-year period. This is the kind of behavior that makes people question the integrity of the financial sector. Proxy firms CGR Glass Lewis and Ownership Matters, which advise institutional investors on voting, have criticized Macquarie for not adequately reducing executive pay. They argue that the measures taken by Macquarie to cut executive profits are not sufficient, especially given the long list of regulatory issues. And this is the part most people miss. The CEO's pay package, while slightly down from the previous year, still stands at a whopping $24.3 million. That's a significant amount of money, even if it's a 5% decrease. The question on everyone's mind is, how can a company justify such high pay when it's facing multiple regulatory challenges? Major international investors, including CalPERS, Kelsters, and SBA Florida, have already announced they will vote against the remuneration report. This is a bold move that could set a precedent for other companies facing similar controversies. Macquarie's chairman, Glenn Stevens, defended the bank's risk culture in his speech to investors. He acknowledged that there have been remuneration impacts for some executives, but emphasized the need for ongoing investment in remediation activities and systems to reinforce frameworks. However, he also admitted that the board has not adequately reflected risk shortcomings in its decisions, a statement that is sure to spark debate among shareholders. As the debate over executive pay and corporate responsibility continues, Macquarie Group faces a crossroads. Will it continue to prioritize profits over accountability, or will it take decisive action to address the concerns of its shareholders and the wider community? The outcome of Thursday's AGM will be closely watched, and the company's future may hang in the balance. What do you think? Is Macquarie's approach to executive pay justified, or should they be doing more to align their compensation with their regulatory challenges? Share your thoughts in the comments below. Let's start a conversation about the future of corporate responsibility in the financial sector. Macquarie Group 1Q profit decline. What you need to know. In a surprising turn of events, Macquarie Group has reported a decline in its profits for the first quarter, primarily driven by challenges in asset management and a decrease in income from commodities. This news raises eyebrows and prompts a deeper look into the factors affecting such a significant financial institution. On another note, Unity Software has just released its financial results for the fourth quarter, and the numbers are quite intriguing. After the market closed on Monday, Unity announced that its revenues of the fourth quarter surged by an impressive 35% compared to the same period last year, reaching a total of $609 million. This figure not only reflects robust growth, but also surpasses analysts' expectations, which had predicted revenue of around $562.71 million. However, it's important to note that despite this revenue growth, the company reported a loss of 66 cents per share for the quarter. For those interested in staying updated on such financial developments, you can either log in or create a free account to access this news and more. It's crucial to remember the information provided here is intended solely for educational and informational purposes. It should not be interpreted as investment advice related to Futu. While we make every effort to ensure the accuracy and originality of our content, we cannot guarantee its completeness or reliability. But here's where it gets controversial. How do we reconcile the impressive revenue growth of Unity with its reported losses? Is this a sign of a company investing heavily in its future, or does it indicate deeper issues that could affect its long-term viability? We invite you to share your thoughts in the comments below. Do you agree with the optimistic outlook, or do you see potential red flags? Let's discuss.